Hello there, Maverick Traders. It is the weekend. This is Rob Reinhold. It is the trading room. We've got one more week left of October. It's crazy that we have just 2 more months left, and then 2025 is in the books. Let's jump into it. In this session, we're going to be going over, as always, what happened this week, some of the news. We'll take a look at the broad markets. We'll then dial down into the sectors, find out what sectors are hot, what sectors are cold, and then we're going to find trades in those sectors.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, let's start off with what happened last week. Last week in the trading room, I said, I expect us to be sideways until Friday. And then when that CPI report comes out, I think we're going to get a break out to the upside or down to the downside, most likely to the upside. And that's basically exactly what happened. We spent 4 days in consolidation, got a breakout on Friday, closing on the highs. So look, I know you may not want to be bullish. I know you may look at this market and say, it's too overvalued, it's done this is just an AI boom. Okay, whatever your excuse is, I don't care. I don't care what it is. I've been saying this for months and months and months. Get on the train. Yes, the train will crash at some time. I agree. I totally agree. But get on the train. It's still moving higher. And just to make the point of how much is moving higher, we had some really bad tariff news this week. It was on, I think, Wednesday after the close, maybe Thursday, we got a news out that Trump was breaking off all talks with Canada over an ad he saw. This would have sent the market down 2% after hours last March and April. The market completely ignored it because the market has learned the taco trade, or just not even the taco trade, but just whatever is said is just rhetoric. Whatever actually happens is the only thing that matters. So the market didn't even care. It didn't care. And by 2 hours later, the futures were higher. Everything was better. Everyone was in a good mood. So this is a hallmark of a bull market. It ignores bad news and celebrates good news. This is exactly what we're seeing. This is why I think we are still going higher. And if we take a look at the earnings last week, weren't good. Netflix, total bomb. And you know what? Market didn't care. Netflix is one of the biggest of the 10 stocks in the NASDAQ. And on the day that Netflix missed earnings, the futures were higher after they missed. Again, same thing. Tesla misses earnings. Guess what? Futures trading higher. It's just saying that people don't care. All the bad news is being ignored. I've seen markets like this many times in my career, and a lot of times it's frustrating. But here's the thing. It keeps going and going and going until one day it doesn't. One day, the bad news all of a sudden matters. And I don't know where that fulcrum is, that switch that gets flipped, but it's not yet. At least I haven't seen it. This market wants to go higher. Because of the government shutdown, we don't really have many economic reports, but we did get the CPI report. They said, we want to get the September CPI report out to the market. They pretty much put every other report on the shelf. They said, we want to get you this one. It is 2 weeks late, but we got it. And you can see this is what happened on Friday with the big spike, is that the inflation was much less than expected. So right now, there is now a 97% chance of a rate cut next week. There is now a 96% chance of another rate cut in December. The market is pricing in 2 rate cuts, which again is very bullish and supportive of higher stock prices. So what were the final numbers by the end of the week? Almost a mirror image of what they were last week. Dow up 2%, S&P up 2%, Q's up 2%, Russell up a little bit more. The only difference was gold topped out. Gold had this big parabolic run and it topped out. I'm always wary after something goes parabolic that typically signals the top, but it doesn't mean it all the time. It just is one of those times where you can look at it and say, okay, it's time to be cautious here. Oil up 7%. This was off of some news that the U.S. sanctioned the two largest oil companies in Russia. This is again some escalation on the U.S.-Russia tensions. Their two biggest producers are big players in the oil market, and this means less supply, so oil, of course, goes up on that. Let's take a look at the S&P. So here's the S&P. We had that big down day where we got that tweet about China, and you can see we've worked our way back up. It's been a little sloppy. It's definitely been sloppy. But if you kind of blur your eyes, it's been just this. It's just been an uprise. We hit up against that resistance this week, and you can see a breakout on Friday. Okay, now look, I am not all sunshine and rainbows because take a look at this next chart. This is the RSP. This is the equally weighted S&P 500. And look, it got hit a little bit harder than the S&P, but it bounced back a little bit harder as well. Same thing, we consolidated for a couple of days. This is not a real great candle to get off of a breakout. It's just not. So what does that mean? Well, I think you know what it means. It means that there are certain stocks that are really cranking, and you know which ones they are: Microsoft, Nvidia, Broadcom, Apple, Amazon, Google, Meta. These are continuing to crank higher. I mean, take a look at how big this area is of the market. Now, again, this is the heat map for the S&P based on market cap. This is literally about half of the market cap of the S&P. They have great weeks. They had fantastic weeks. Outside of that, not so great. So yes, we continue to have a narrow market. But let me go back to the RSP. The RSP actually did better than the S&P over the last 2 weeks. It really has. Ever since that Trump tweet about China, it's recovered much better. So I don't want anyone to say, there it is. That's the reason why I'm going to stay bearish. It's not a good reason. It's just a realization that while everything is going up, there are 10 stocks that are going up a little bit more than everything else. That's all it is. So look, if there was any doubt in anyone's mind this week, the bullish trend was affirmed. Bad news completely brushed off. Good news celebrated. Everything's fine. Everything's good. So it looks like we're going to get more of what we've seen over the last 6 months. I already talked about Fed rate cuts. I mean, the rate cuts are basically baked into the price of stocks, which means if the Fed backs off of that, and we'll hear from the Fed this week, if they back off of it, the market needs to be repriced. And of course, we're in third quarter earnings, so always check your earnings. I've got a trade here actually with earnings coming up that I do like quite a bit. Okay, let's talk about economic reports. There's a lot on the schedule, but guess what? None of it's going to happen. The only thing that will come out is if it's a private company doing the report, and I don't see any private reports on here. The big thing this week is the Fed meeting. The Fed meeting will happen regardless of the government shutdown, and you can see we are poised for a 25 basis point rate cut. Okay, it's baked in the cake. Everyone knows it. Everyone expects it. Everything's been priced in. Here's the interesting thing. On Friday, when we got that CPI report that, pretty much cements that we're going to get more rate cuts, the dollar went up and bond yields didn't go down. They went sideways. It's telling you that this has been priced in the market. This is why the market has been so strong, because this is baked into the cake. So we know we're going to get the 25 basis cut on Wednesday. The press conference is going to be the most important thing here. If Powell is not as dovish as the market wants, the market could get disappointed. I expect that they're going to be fairly dovish. I think this Fed meeting is really not that big of a deal. I think we'll sail through this one and not really bad night. Yes, there's going to be volatility for an hour or two after the meeting, as always, but I think we're going to just sail through this one and not have that big of a deal. One other thing I want to point out, we're probably not going to get the GDP report, but the projections of third quarter GDP are 3%. Again, for any of you who are looking at this market and you're still bearish saying what's going on, 3% GDP. We have not seen 3% GDP, especially consecutive quarters of 3% GDP, in a long time. I I think even the first Trump term didn't have 2 consecutive quarters of 3% GDP. I think you have to go back to like maybe even 2007. I mean, this is a good growth economy at the moment. Now, look, yes, I know we can point to lower income earners and how they're getting squeezed. I know there's all this problem out here, but we're just talking about corporate earnings. That's all we're looking at is stocks. 3% is a killer GDP for an economy of this size. So, again, another reason why if you were bearish, that number should slap you in the face and say, hey, you've got to look at the numbers. This is a bull market. So, we were at a +3. We got that big pullback back in October. We moved to a +1, still remain bullish. We moved to a +2 as we strengthened, and now we're back to a +3. So here we are. We're off to the races. We're at all-time highs. We just had a breakout after 2-week consolidation. What reason is there to be bearish here? There's just not. Here is the weekly returns for all the sectors. And here we go. We shouldn't be surprised. Tech. This is where all the money's going. You can see everything else had a decent week. The one thing I want to point out is comm services. Usually, we would see tech and comm services because, again, comm services, you got Google, you got Meta. You can see here, comm services really underperformed. Really underperformed. So I'm looking at that saying, you know what? I'm not interested in those type of stocks. I'm more interested in technology. What else did better? Industrials. Industrials I like quite a bit on this one. Energy bounced back, but energy's been very weak. We'll take a look at it. Our 2 +3 sectors were utilities and healthcare. And you see utilities was basically flat. Healthcare was the 4th best sector. So we continue to like healthcare. Let's take a look at all of the sectors and score them from a -3 to a +3. Utilities had a pullback. We held that 20-day moving average. We got a bounce off of it. Remains a +3. I think it's a good setup here. I actually like this setup better in utilities here than I did last week. I like that pullback to a moving average. Next up, communication services. It's a 0. It's a 0. Take a look at these candles. They're just not great. You'll see other candles much, much better. So comm services just stays at a 0. All right, real estate. Real estate broke out. It was a 0. Got to move it to a +2, but I'm a reluctant +2. These aren't great candles. We gapped up, but no one really bought us. And then we gapped up again and no one really bought us. It's a +2, but I'm not super crazy about real estate here, but it is a +2, technically speaking. Next up, healthcare. Love it. This is a good looking candle. Now, yes, we didn't have the explosion on Friday, but look how well we held in. We actually rose for the first 4 days of the week where the rest of the market languished. +3 all day. Over here to industrials. All right, we've moved up to a +1. Okay, we've got some resistance up here. Yes, Friday's candle wasn't great. It's a +1. That's all I can say. It's a +1. It's not fantastic. It's not terrible. Here we have financials. Financials, -1. That being said, I think the candles look pretty good. Candles look pretty good. We went higher. It's okay. So if you want to move this to a 0, fine. Move it to a 0. It's okay. Here we have consumer discretionary at a +1. Again, it's okay. It's not great. It's okay. Over here to consumer staples, we had this nice rise over the last week or two, but you can see it kind of fizzled out. And these candles, not great candles. Gap up, falls, especially Friday's candle. Not a great candle on Friday when the market was up big. So we're going to stay to 0 here on this. It's between the moving averages. Here we have tech. All right, tech's breaking out. Tech's breaking out. We based for almost 3 weeks. It's a breakout. So it's a +3. We went from a +2 to a +3. So again, you may not like it. You may not agree. I don't care. The chart is telling you it's a +3. Here we have materials. Materials was a -2 last week. It got a little better, but you can see we're still below moving averages. It's not great. So -1 on materials. And energy was one of our weakest sectors last week. And you can see it had a bounce. It had a bounce, but it's a zero. It's a zero. And I think we're probably going to see this work its way lower. So here's where we were last week. And we talked about how we had a narrow market, healthcare, utilities, technology all working, and then everything else a little bit soggy, a little bit weak. So let's go ahead and move that technology up. It moves up to a +3. Tech looks great here. What else moved up? Well, we got moves up in materials, financials to a -1, real estate, consumer industrials go to a +1, energy goes to a 0. So as you can see, the soggy stuff, I'll use the term soggy, got a little bit better, but it's not great. It's not great. The best stuff there is real estate, consumer, and industrials. The weakest is materials and financials. So we've got this clear outperformance. Tech, healthcare, some of the utilities are doing well. And then we got the rest of the market that's just kind of out there. So we really need to be cautious and really focus on our trading slots. And this is where sector analysis really helps out. To be overly long the good stuff, overly short the bad stuff, and then everything in the middle, not be too far out. Last week, we had 3 trades roll off. Ironically, we had 1 bull and 2 bears. Now, the market had been up about 5% since these trades were made 2 weeks ago. And ironically, utilities was a loser. Southern Company, SO, was a loss. And then the shorts were actually both winners. We had Deckers and CTVA were both winners. So this is where it's always funny how trading works. You try to be long the strong sectors, short the weak sectors. And if the market goes up, you assume you're going to lose money on your shorts and make money on your longs. It doesn't always work out that way. This is why we really like this strategy. All right, we're at a +3. So our allocations are going to change. Last week we were at a +2. Now we're at a +3. So now we can actually open up some more bullish slots. So I'm going to keep it kind of tight. As you can see, I'm not adding any +3s. And I'm also not adding any +2s. I'm just staying right here. So the most bearish I'm going to get is mildly bearish. The most bullish I'm going to get is moderately bullish. And you can see I'm going to add some trades in utilities and financials at a +1, industrials and consumer at a +2, and I'm going to add 1 bear in materials. So let's go ahead and jump into some of those potential trades. First up is the utility sector. And I've got Next Era Energy. So again, monster run, especially for a utility company. We got 70 up to 85. I mean, boy, what is that? That's like a 17% rally. And we've got this really, really mild pullback. Now look, it's great candles, but look, gap up and fall, gap up and fall, gap up and fall, gap up and fall. Again, every one of these days was a gap up and fall. And then all of a sudden, we get a gap down and a buy. This is, again, we've got our reversal candles, we got our grain candles. We have no idea what's going to happen in the future, but this bull pullback pattern is one that has a statistical probabilities of being higher than lower. I already determined I'm doing a +1, so I'm just going to do a buy in the money and sell in at the money call. So I'm looking at 83.85. So I'm looking to buy this one. I'm probably going to get in about 60% of the spread. So I got 40% of the upside. Anything above 85 is golden. I'm not looking to have this thing run and go higher. I'm just looking forward to hang around in here. Hang around in here. If you want to be more bullish, give it one more week. Go 84, 87. I think that is the right trade for that one to get the right amount of delta. So NEE, Next Era Energy. Next up in industrials, we already decided we're going to do a +2. So I'm looking for something that's got some juice. This is Kratos. This is a defense and aerospace contractor. I really like this industry group. It's doing the best in industrials for sure, and had a monster run. If you go all the way back, I mean, this run really started like 50% ago. So it had a 100% run. And you can see we've come down from 112 all the way down into the 80s. So we've had roughly a 23, 24% pullback. It came into the range of the 20, 50-day moving average, spent a couple days out of it. It looks like it's moving out. Look, The candle on Friday isn't fantastic, but I really wanted to be in this industry group because it is the outperforming group inside of the industrial sector. I determined I'm doing a +2, so I'm going to go out 3 weeks. I'm doing the 90-95. You can see I'm not asking for it to do a whole bunch. It just needs to be above 95 in that 3 weeks. It can go wherever it wants, but I just want it to be above 95. If you want to be a little bit less bullish, go 2 weeks out, 88.92. Just a slight move higher, you're going to get a max gain on that one. There's other stuff in this industry group. You can take a look at it. Everything looks really good inside. In financials, determined we're going to do a +1. So looking for something that is slightly bullish. This is Interactive Brokers. So this is who we use for our trading, Interactive Brokers. You can see here, we got down to this 50-day moving average, and we got some chop, but long lower shadows. And then on Thursday, we got the nice bounce. Friday, we got the extension of it. Okay, so we've got this bull pullback. It's triggered. Do I think this thing is going to run up and make new highs at 80? Probably eventually. In this run? No. But again, that's not what I'm going for. I've already determined I'm going to be a +1, so I just want it to not go down. I'm looking at the 66.69. Basically saying, I think it closes above 69, somewhere up in here. I don't care where. Anywhere above 69 is a max gain on this +1 trade. If you want to be more bullish, 68.71. I think that's about where you want to be. But I don't think the financial sector is as strong as others. I would much rather be more bullish in other sectors. Our other +2 was in the consumer sector. So this is Etsy. Now, first off, Etsy has earnings on October 28th. As you can see, a beautiful high base has been forming here off of this run. We haven't quite poked our head out of it. Let's talk about earnings. Now, my rule is if I do a trade, my trade into earnings must have greater risk than reward. I will not do a +1 trade into earnings. I will not do diagonal call spreads into earnings. I need this, again, expectation that if it has a big move, one way or the other, I make more than I lose. That way I can put the risk reward in my favor. There is going to be a big move on October 28th. And that's really the only thing that matters in this trade is this earnings report. So my call is it's going to be to the upside since it's a high base. I'm looking at the 73.77. So this is going to be a +2 trade, looking to have it move out of this high base and start to move its way higher. We'll see what happens. Again, this is an earnings play. Whatever happens on earnings is going to determine the P&L on this trade. And then last, we've got materials where we're going to do our -1. Again, remember, -1 is not aggressively bearish. It's, I don't think it's going to go any higher. So this is CF Industries. This is a fertilizer company. And the other big fertilizer company is Mosaic, and they're doing much worse. But you can see we've got this nice breakdown, bear rally, got a doji, got the confirmation candle. So here we are. This is not a call that I think this thing is crashing. This is, hey, you know what? I think 86, 87 is about the top for this that we're going to see in the next week or two. I was looking to do a -1 anyway. So I'm just going to say, hey, I'm going to sell the 86, 88 bear put spread. Sorry, I'm going to buy it. I'll go long. It'll be a long trade here. It'll be a debit. I'm probably going to pay about 60% of the spread, and it's going to be mostly theta. I just need it to be below 86 on November 7th. I don't care where it goes. And I really like this level as some resistance on this. Again, I'm not looking to put my neck out there on very many sectors other than technology, which I'm already overweight in. That's really the only place I feel this market is going. And really, you want to probably stick with those Mag 10 names, which is the NVIDIAs, the Apples, the Metas, the Googles. I like the technology better than the comm services, but look, this market's bullish and it's being driven by the big names. Like, I get it. We're in a bubble. Yes, I get it. It's going to pop one day. I totally agree. But as traders, we're talking here and now. What is the market doing now? It's going up. And it has been going up. And I've been saying the same thing for 6 months. It's going to end when it ends. Until then, you've got to be long and strong. So prepare up. There is earnings season. Make sure you know which stocks are having earnings when you're making your plays, and make sure that you've got your risk reward in place. I've been warning about high volatility for the last 2 weeks. Like high volatility, there's lots of stuff going on to where we had a pretty calm market. I feel like that's all gone away. This week, we had lots of stuff thrown at us. And you know what? The market is calm. They didn't care about the the Canada tariffs. They didn't care. They don't care. The market doesn't care. It's low volatility. So I really give a warning of people doing, short options trades. Say, hey, this isn't the market for it. We're probably getting back into that market. I think it's going to be a better market for that strategy. Everyone have a great weekend. Thanks for joining me. Take care. Goodbye.